Good morning. It's the 2nd of August, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take, trigger-happy tax officials. Think of the tax official as a senior sales manager in, let's say, a firm selling air conditioners or color televisions. Their job is to sell the maximum number of color televisions, to which is linked their performance grading and, of course, a bonus at the end of the year. Substitute the sales manager with an income tax official. They have similar targets, and their job is to look for infractions in law in various companies and build a case which usually involves the highest amount of possible tax. After all, their job by collecting more taxes is to help the government earn more revenue, and more revenue or taxes means, at least in theory, much more better quality of services for you and me. Now, the tax fraternity calls these high-pitched assessments, which means the tax officials build cases involving almost impossible tax demands, which usually go and die, quite literally because the demands get struck down or diluted in appeals or in courts much later. But even as this happens, there's a cost to it. Companies have to, as in the case of Infosys, which we will come to, spend time and effort fighting back, including in some cases dashing to court. So Reuters is now reporting that tax officials could issue some more notices to IT services companies in an investigation of possible tax evasion related to work done by their overseas offices after Infosys was slapped with a roughly $4 billion or 34,000 crore rupee tax demand. In serving this highest ever tax demand on Infosys, says Reuters, the government has accused India's second largest tech services company of evading taxes or almost all its revenue for the quarter ended June 30th. The National Association of Software and Services Companies, NASSCOM, the industry group, was quick to issue a statement and said the tax demand reflects a lack of understanding of the industry's operating model and that companies are facing avoidable litigation uncertainty as well as concerns from investors and customers due to such actions from the government. Infosys said late on Wednesday it had received a pre-show cause notice from the tax authorities but believed the relevant taxes had been paid and that it was in compliance with all regulations. Now, overseas offices carry out projects for Indian IT firms and provide services to international clients amongst other functions, and more on that in a bit. The broader logic is quite simple. If Infosys is exporting services, it ought to be entitled to not pay tax whichever way you treat an income incurred in an overseas branch. Now, the tax department evidently feels if the overseas branch has rendered a service to the head office in India, then a tax must be paid. It's not clear to me how, but we will come to that shortly in the words of an expert. So Reuters points out that in the last year, India's Goods and Services Tax Department has sent more than 1,000 notices to companies, including the big ones like government-owned Life Insurance Corporation of India and private companies like Dr. Reddy's Laboratories and Ultratech Cement. They've also issued notices to online gaming companies demanding about 100,000 crore rupees in taxes that they have allegedly evaded. Now, it's quite obvious that a lot of this will never materialize. It's also worrying in some ways that online gaming companies are seemingly falling into the same target group as an Infosys, given that such organizations should surely attract higher sin taxes and thus be restricted in terms of who they sell their services to. Now, even if everyone knows that these tax assessments or demands will not materialize, valuable top management time will go in responding to the notices and to questions about these notices, including from media organizations like us. Think about it from the other side. As a principal sitting in, let's say, the United States, I may be hesitant or worried if my vendor, a leading IT services company, is likely to spend critical management time fighting such large tax cases, even if I am not affected directly by it. Tax officials, to their credit, have been doing a good job in expanding the tax net and also going after offenders, as in the case of goods and services tax. But equally, they must focus on areas where there is evasion and the cases are more open and shut. Elsewhere, they must strive for more balance to be found as well. That brings us to the top stories and themes for the day. Global cues push Indian markets to record closing highs. Goods and services data is better for July and the numbers are being announced once again. Maruti's record growth is fueled by customers buying CNG cars, with a third of cars running on them. High-pitched tax assessments like Infosys, the case and impact. And did online discount brokerages trigger the explosion and thus the heightened scrutiny of India's derivatives traders?
This is the Core Report with Govindraj Ethiraj.
Markets and oil. The stock markets picked up pace once again as a gentle tailwind lifted both the Sensex and Nifty 50 to settle at record closing highs on Thursday. The Sensex earlier hit an all-time high of 82,129 before closing up 126 points to 81,867, while the Nifty 50 ended 10 points above the 25,000 mark at 25,010. The Nifty earlier hit a record high at 25,078. All of this is on trade on Thursday. The big movers, according to Business Standard, were Power Grid Corporation, Coal India, ONGC, HDFC Bank, and Dr. Reddy's Laboratories, which gained about 4%. Some 28 of 50 Nifty companies ended higher. However, on the other hand, the mid-cap and small-cap indices were down, though marginally. One reason for the bullishness was the prospect of a US interest rate cut. Yes, that's returned to the table in September, which could likely trigger more foreign inflows into domestic equities. Speaking of US and Wall Street, analysts have also bought back into the nvidia hypergrowth story, which seemed a little weak for the last 2 weeks. Nvidia shares were up about 13% on Wednesday after Microsoft and rival AMD said that there would not be a slowdown in the multi-billion-dollar build-out of AI servers or artificial intelligence servers based around GPUs or graphic processing units, according to CNBC. Microsoft CEO Satya Nadella and Finance Chief Amy Hood said on Tuesday that their company planned to spend even more on NVIDIA-based chips or infrastructure, according to CNBC once again. NVIDIA, as we've been talking about here, has been a key beneficiary of the AI boom, and its stock has doubled so far in 2024 and is up more than 500% since ChatGPT's release in November 2022, when the world woke up to this new technology phenomenon, which of course promised to have turned the world upside down also by now, which of course has not happened, at least so far, and that was metaphorically speaking either ways. Morgan Stanley analysts have apparently named NVIDIA a top pick in a note on Wednesday, saying that concerns including competitive dynamics, export controls, and supply chain concerns are likely to fade with time. The controls are to countries like China. On a slightly different note on interest rates, once again, the Bank of England cut interest rates from a 16-year high on Thursday. It will reduce borrowing costs by a quarter point to 5%. But this is the first time that there's been a cut in rates in England since March 2020 at the start of COVID-19 pandemic, and I presume that holds out hopes for a quicker or sooner Federal Reserve rate cut in the United States. GST data is released once again. Meanwhile, gross GST or goods and services tax collections rose about 10% in July to over 182,000 crore rupees or 1.82 trillion rupees, according to official data released on Thursday, and that's the underlined word. The news, therefore, is that they have been released after the data was not announced formally but released selectively last month, mostly because the figures seemed lower. Right now, net goods and services tax collection after accounting for refunds was about 1.66 trillion rupees or 166,000 crores, up 14%. GST revenues had hit a record high of 2.1 trillion or 210,000 crore rupees in April 2024, according to the Business Standard. Oil prices are still high. Oil prices rose again after Iran was reported to have ordered a retaliatory strike on Israel for killing a Hamas leader on its soil, according to Bloomberg. Brent crude was quoting over $81 a barrel, not as high as what it was a few weeks ago, around $86, $87 a barrel, but up, or rather back up from the $79 it hit earlier last week. Bloomberg reported that the fresh tensions in the Middle East have led to a flurry of activity in the oil options market, and traders are also waiting for OPEC, that's the Organization of Petroleum Exporting Countries' decision in coming weeks around the pace at which it unwinds its cuts, and of course Chinese demand. How cheap compressed natural gas is driving Maruti's sales. One of every 3 car models sold by the country's biggest car maker, Maruti Suzuki, were powered by CNG, the company revealed in a post-earnings call on Wednesday. I'm not sure if you know that, but most people don't. Moreover, this is the first quarter where CNG sales have outpaced diesel across the passenger vehicle segment, the company said. Now, driving a CNG vehicle could cost up to 30 to 40% less compared to petrols, but that's a very rough calculation. Overall savings could be computed, my sense is, only if you drive beyond a certain amount, since you pay more for CNG cars, and of course, if you can live with valuable boot space sacrificed to a gas tank. Maruti sold about 150,000 CNG vehicles in the first quarter of this year, including in some of the relatively higher-end models. CNG vehicles are obviously, apart from being more economical to run, more fuel efficient and also more friendly in terms of air pollution. A research report from ICICI Securities says that the CNG mix, that's Maruti's CNG mix, was previously hit by supply-side disruptions but is now standing at that 33% or a third compared to about 27% last year. So the interesting factor from Maruti's results is that 42% of buyers are first-time buyers, while additional car buyers are at 38%, and replacement demand is at about 20%. A good CNG mix, ICICI Securities says, will also help Maruti deliver higher margins. Speaking of cars and margins, Tata Motors' first quarter profit rose, beating analysts' estimate thanks to a surge in sales in its British subsidiary, Jaguar Land Rover. Consolidated net profit for Tata Motors, which also makes Nexon, rose about 72% year on year to about 5,600 crores in the 3 months ended June, on the back of revenue that rose about 6% to about 108,000 crores, according to an exchange filing on Thursday reported by Bloomberg. The Infosys GST tax case. Returning to Infosys, the country's second largest IT services company, it received a goods and services tax demand of close to 34,000 crores. Now, the demand is related to services availed by Infosys from its overseas branches over a 5-year period starting in 2017, according to a Reuters report. The tax document details that Infosys paid consideration to its overseas branches in the form of expenses. Consequently, Infosys is deemed liable to pay integrated goods and services tax under the reverse charge mechanism. Explanations on that coming up. On these supplies, amounting to about 32,000 crores in the last 5 years, or rather the 5 years from 17 to 22. Now, the reverse charge mechanism system mandates that the recipient of goods or services, rather than the supplier, pays the tax. Now, Infosys has said in an exchange filing that it has settled all dues and maintained that GST is not applicable to the expenses claimed. For a better understanding and some background, I spoke to Sachin Menon, senior tax consultant and former KPMG partner, and I began by asking him how the tax liability worked for an export-oriented service company like Infosys.
So this is a news item today in most of the papers that Infosys slapped with the notice of 34,000 crores for the demand from GST authorities. Before we are coming to any conclusion about the liability which is being slapped on them, let us understand that how this software export companies operate. In normal course, there are different business models which the different companies for. But as of now, from whatever maybe those media news and whatever is reported, I can't fathom what is the model which they are following. But normal course, the way this software companies having huge export orders from countries like US or the Euro structure is that they normally have some branches in those companies for various reasons, because when they are sending the IT professionals from here to US or Euro, there are so many formalities, like they have to have an office there for administrative reasons, visa purposes, etc. So normally they open a branch there, and the employees traveling from here will be going to the branch and they would be executing those engagements from there or the client side, as the case may be. Now, and I understand that these branches also provide the on-site services to the customer while they are executing their software contracts. And then Infosys put the expenses of the salary and the overhead expenses, rentals, etc. for running a branch office in such locations. So normally what happens is that the contract is executed, Infosys bill the US client after the contract is executed, they get their money. And that is considered to be or declared in the GST return as export of services. At the same time, the expense side, for maintaining the office, they make remittances with a reference to their salaries or expenses or transportation, visa processing, etc., etc. Now, the department's view seems to be that when Infosys is sending the money for the branch expenses or overhead expenses, in fact, such branches are considered under the GST law as distinct persons. And as per the law, any transaction between the head office and the branches would be subject to GST. So their argument is that whatever money they are funding the branches for the day-to-day functioning, etc., is nothing but a consideration for service received by the Infosys India. And therefore, those expenses for the last 5 years, Infosys is supposed to pay GST. And since they have invoked Section 74, which is suppression, misdeclaration, concealment, etc., that 5 years they will have to calculate what could be the demand amount and 18% interest plus penalty. That seems to be this amount of 34,000 crores, 34,400 crores or something which they are talking about. So this is the brief picture of what could have happened. Some variations in that model, etc. But this is generally what is being seen.
You're saying, despite the fact that the income for the entire project is in the form of an export, what you might incur underneath that in these payments to, let's say, the branch for various activities could draw or could attract local goods and services tax.
Yeah, it would be considered as import of services, and therefore a reverse charge mechanism under which they have to pay. They can raise a self-invoice and make the payment, file returns and show that. That's what the department says.
And what's your sense on how strong this case is?
So first and foremost is that there is old service tax cases, because there is not much of a difference of this model during the service tax regime and now. And even perhaps the legal provisions are also copied from the service tax law and pasted in the GST law. So there is not much of a difference between the legal position under service tax law as well as the GST law. So during that period of time, there was some orders, I think it is in the case of Infosys only, that such reimbursement, such expenses is not for receiving any service. I am running an office, branch office, and I am paying my overhead expenses and other salaries or whatever, which is supposed to be incurred at the branch level. It is not for any receiving any import of service, but it is actually normal expenses, administrative expenses for a branch. First question is whether there is any service at all. Even if we argue that there is a service, then the point is that number one is that the input credit is fully available. Once you pay reverse charge mechanism, if Infosys pay 18% GST, then immediately Infosys is eligible to take the credit of that tax what they has paid and claim a refund of that as an export incentive. They are eligible to get the refund of whatever may be those input taxes incurred. So it's a zero-sum game as far as the government is concerned. But most importantly, the government recently clarified as recent as 26th of June 2024 by the circular number 210. They clarified that in the case where the distinct persons, so there is a terminology used for branches and the principal relationship, they call it as a distinct person. In such a transaction where the head office incurred some expenses to the branch, and the branch is eligible to take the full of such tax which is payable. In such case, one thing is that you can raise an invoice on the branch and charge GST, etc. at the market value plus 10% or whatever. And if you are not doing that, then as per this provisions of GST law, whatever may be the amount payable, you are mentioning will be accepted as the value for the services so provided. And it's also clarified that in case of import of services also, in case if there is no such invoice are raised, then it should be deemed to be the value of such services deemed to be nil, and therefore they need not make any payment. It is accepted. So that circular also is actually totally negating this demand which is issued. So to me, prima facie, it looks like a kind of a storm in the teacup. It makes sensational, giving a 34,300 crore worth of demand slapped on Infosys, etc. So the media can say, go gaga about it, discussing about it, etc. department officers are very, very happy about slapping such notices and finding out some ways to interpret the law the way they understand it. But ultimately, I think that this would go to the adjudication level. According to me, Infosys is on a very strong footing as far as this case is concerned.
Right. Thank you so much for joining me.
Thank you.
The perils of futures and option trade. There has been much discussion on futures and options trade and what the Securities and Exchange Board of India is doing to cool down this space. So the noteworthy statistic is that 9 of 10 individual traders in equity futures and options lose money at a net level in this country. Many traders, as we've discussed, are young and have likely borrowed money to fund this trading. Many realize only once fully entrenched that they're also subject to high transaction costs. Much of this explosion in activity, as we've discussed again, has been driven by the ease of opening trading accounts and then diving into the derivatives universe. Quite simply, as we've also argued, that there is a need for greater friction in such transactions, including perhaps for the opening of these accounts. Rajesh Baheti of Crosseas Group now joins me to talk about what is wrong with futures and options in India, and more importantly, what a healthy futures and options trading strategy could be. Rajesh Baheti specializes in providing low-cost trading platforms for high-volume day traders as well as jobbers, and also runs proprietary books for jobbing, hedging, and arbitrage businesses in the stock markets. Rajesh, thank you so much for joining me today. So let me pick up on some of the disclosures that you've made on derivatives on your own website, which means you're telling people that this is a risky proposition to start with, which is what SEBI is also saying, which is that 9 of 10 individual traders in equity, F&O, or futures and options lose money. Then even those who make money, they actually lose out a lot further because of transaction costs, which they may not realize earlier. And eventually, or finally, most of them register a net trading loss of almost 50,000 rupees. So what I can see is, including from other data, a lot of people who come into this space are young. Secondly, they're losing a lot of money. And thirdly, they're also losing money, which in areas where perhaps they don't realize, for example, transaction costs. And yet they're obviously coming and participating in this market. So let me start by asking you the flip question first. What is wrong with the way people are approaching derivatives?
So, two ways to look at it. Firstly, what is wrong with the way the industry, or my industry in particular, has approached derivatives? I think, post COVID, online broking, discount broking became the big hit, and volumes exploded thanks to the fact that you had 2 years where you pretty much did nothing from home except log into your phones or computers, and it was the easiest thing to do and to keep yourself entertained as well as productive. So one of the things I think I would blame my industry, and more particularly the discount brokerage houses, is that they onboarded a lot of people and allowed them to trade every market as long as the person trading that market wanted to trade. So no kind of assessment was done as to what is the risk appetite, what is the net worth status of the person who wants to enter the market and trade derivatives. But rather, everybody who opened an account pretty much got a limit based on what they sent to the broker to trade whatever product they wanted to. So the first question, therefore, is that should there have been a product suitability framework, which we are all talking about? And SEBI has also been talking about it, but I think our industry is at fault. Maybe we should have devised our own product suitability framework and prevented a lot of people from even entering this space if we had felt that they were probably not capable of handling the risks or understanding the risk. So, in all fairness, I think we are all to blame a little bit. In my own brokerage house, we have not more than 1 or 2% of the clients who are permitted to trade the derivative segment. Most of them are refused because it's a smaller broking house. And I have a personal connect. I kind of tell the clients, no, this is a risky product and it's not for you. But these online brokerage houses are kind of, I don't see you, you don't see me. And there's some computer bots probably accepting applications and processing these. So I think that check was missing. So to that extent, it allowed a lot of people who didn't know exactly the risks and benefits of derivatives to come in and trade. That's one point. The second thing is, obviously, this is a product with which you can control risk and you can also enhance risk. I think the public doesn't understand That to the extent that what is it that you can do to control risk. So that is obviously hedging your portfolio, buying some protection from time to time, given some certain events along the way, and versus trying to make a quick buck by saying, I'm getting an option at $1, 1 rupee. I can buy 10,000 of this. It's just 10,000 maximum loss. But if I win, I can win big. So it was a bit like a lottery, buying a lottery ticket. And I think that kind of education is missing with the investors, and something could have been done on that front.
So, Rajesh, let me ask you to illustrate that. So, for example, let's say we said, okay, if I were to buy 100 shares of Tata Steel or Reliance Industries today, what could healthy derivative strategy be at this point?
So the most popular and healthiest derivative strategy is that you buy the underlying, let's say you bought the Tata Motor stock at say 1,000 rupees, and you say, okay, I expect this share to go up, but I also don't think it's going to, go to 1,500 or 2,000. And to hedge my risk, I will sell a 1,100 call or 1,200 call. So while I own the stock, I'm able to derive some income from this stock by selling the calls. And if it were to go to 1,100 or 1,200 or beyond, I'm happy to take my 10, 15 or 20% gain and exit the stock. So the most popular investor strategy in future and options is what we call the covered call strategy, where you own the underlying and then you sell calls on it. Those are typically out of the money. So that leaves a little bit on the table for capital appreciation. And while that capital appreciation doesn't take place, you're earning some kind of yield by selling those options. So the most favored strategy, or the most advocated strategy for the uninitiated, is the covered call strategy on your investment.
So, which means, and thus, which would have also answered my next question, is the link between the underlying stock and the activity in the derivative segment. But I'll come to that in a second. Do most people, or is there a proportion of people you feel do this, which is to have the underlying stock and then buy into a derivatives cover call strategy, for example?
So lots of people have different strategies. So the people who understand the market a bit definitely do this. The second thing is people also do the arbitrage business. So you buy in the underlying cash market as long as the yields are at or above the bank FD rates, you would sell the futures. So one thing I want to reveal here, that SEBI did this study and they have said that 60,000 crores have been lost in the derivatives market, and derivatives market is supposed to be hedging. I think there is some basic fault with this calculation. If you've calculated that 60,000 has been lost in the F&O space, have you worked out how much of it was a hedging play? Because if I'm likely to hedge my portfolio, and in a roaring bull market, the hedge will always lose money. So if I'm let's say doing a arbitrage strategy, I'll be buying the underlying and selling the futures. Obviously, the market goes up 500 points and I've booked only 10 points as my arbitrage profit. I will make 500 in my cash segment and I will be a loser to the extent of 490 in the derivatives because I've locked my gain at 10. So when SEBI did this study, did it only take the 490 that we lost on the derivative segment as the futures and options losses? Or did they look at a corresponding position of that same retail player in the cash segment to remove the hedging loss?
Got it. But what's your sense, Rajesh? I mean, do you feel that most of it is locked into underlying stock, which would have appreciated, and therefore the difference is lower?
I mean, look at you're saying last year the retail kind of lost 60,000 crores on derivatives. What is a market cap gain in this country? What? It's 10 lakh crores, 15 lakh crores. How much? So how much of that gain has been lost in the derivatives? Obviously, I'm sure at least 40 to 50% of it would have been on account of hedging. Even all the arbitrage mutual funds and people who do arbitrage have all lost money in the futures and options space, but they've had corresponding profits in the underlying.
Got it. So let me come to the last question as we run out of time, Rajesh. So, one of the instances, at least that I could see, is the problem of younger investors or less mature investors who are maybe disproportionately overexposed in this space. I think when you talk about those who have underlying exposure, obviously they've understood the markets a little better. They're buying Tata Motors and then also taking a position. When it comes to the younger lot, who are clearly maybe post-COVID entrants in many cases, what is your sense? I mean, what should people be doing or not doing? I mean, not that they will listen to you and me, but what should be their approach to entering the market? Also in the context of where the markets are today. We've again at record high closes for Nifty and Sensex, for example.
So clearly, I think product suitability framework, the fact is that the industry also needs to be responsible in not allowing everybody who wants to activate the F&O segment to activate it, to possibly have a one-on-one viva. Understand the space. What do you think is an option? What are the risks of an option seller versus what are the risks of an option buyer? What are the payoffs? Do you understand delta? Do you understand that if you're buying a 0.1 delta of an option, there's only a 10% chance that you will make money? So all those things, if you do some kind of an educative analysis, then yes, you will be onboarding fewer people, but you will be onboarding those people that you think are able to trade and these markets well. But as I said, to some extent, I think there has been mass onboarding, and you know what they've done. They have reduced brokerage rates to such an extent, but derivatives, still you're earning so much brokerage that you made delivery free in those cases. So the derivatives profits for the brokerage houses are paying for the free delivery brokers that all these sites kind of advertise. I think that is where the control was needed. Who are the kind of people who want to actually enter and trade the derivatives market rather than actually putting spokes in the seller space? Because most of the retail is buying options. And that's my theory, that most of the retail wants to play with 25, 30 the grand that they're making, or whatever salary they're making. 25, 30 grand in the option space is like a lottery ticket. But if they were interviewed before they would be allowed to trade F&O, I think a lot of this could have been prevented.
Right. So are you saying that there should be like a net worth cutoff or some other kind of barrier before they actually start trading?
So two ways to look at it is one, there's an arbitrage today between an option buying and option selling. Option selling requires, say, if the lot size is 20 lakhs and the margin is 25%, it requires a minimum of 5 lakhs. Option buying, if you're buying a 1 rupee option, 10,000 shares, you have to pay only 10,000 lakhs. So one of the solutions to kind of level this arbitrage is to say whether you're buying an option or you're selling an option, you've got to keep a minimum base capital of 5 lakhs or 10 lakhs, whatever the number you come up with. The minute you remove this arbitrage of the premium required to buy an option versus the premium or the capital required to buy an option versus the capital required to sell an option, I think all this frivolous lottery ticket buying would have stopped there and then. So the easiest solution should have been to say, it doesn't matter if you want to do F&O, you got to have a minimum balance of 5 lakhs or 10 lakhs with the broker. Whether you're buying a 10,000 rupee option or selling a 10 lakh rupee option, you got to have that minimum base capital with the broker. That would have killed that arbitrage and made people do the wise trades rather than just get into this lottery kind of thing.
And quite likely that might happen, as you say, Rajesh. So thank you so much for joining me.
Thanks.
That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in, and thank you once again for listening.